A petty cash fund is a sum of cash kept separate and is used to pay a business's minor expenses. These expenses vary across different businesses and as a result, so does the size of the petty fund cash account. Examples of expenses include supplies, postage, or fuel for company vehicles. To establish the petty cash fund, a check is written for the amount of the fund. The check is then cashed and given to an employee of the business who is dedicated to covering petty expenses. To establish the fund, the following journal entry occurs. The petty cash fund account is debited for an amount, in this case $200, and the cash account is then credited $200. As a result, assets is increased by $200 due to the increase in the petty cash fund account, but then decreased by $200 due to the decrease in the cash account, meaning the accounting balance remains equal. The cash that is used to pay for expenses decreases the amount of the petty cash fund account. As a result, the remaining amount left in the fund, in this case $50, is counted and deducted from the fund amount of $200, meaning a check needs to be cashed for the amount left over, which is $150. This $150 represents the amount which was used for expenses and on the petty cash fund replenishment report is dedicated to specific expenses, in this case $100 to fuel for deliveries and $50 to miscellaneous expenses. As a check is cashed to replenish the petty fund cash account, a journal entry is required. This entry involves the specific expense accounts being debited and then the cash account being credited to replenish the fund. In this case, fuel expenses is debited for $100 and miscellaneous expenses is debited for $50. Then, the cash account is credited for $150. As a result, assets is decreased due to the decrease in cash by $150. Equity is also decreased due to the expenses paid of $150. This ensures that the accounting equation remains equal.